Hey everyone, and welcome to this explainer. Now, a master's student recently reached out to us asking for a complete breakdown of a very specific, highly influential piece of financial literature, so that's exactly what we're going to do today. We're going to conduct a structured academic autopsy on a major shift in global bank accounting. We're digging into a critical piece of empirical research that looks at what happens when the entire financial world completely changes its mind about how to prepare for a crisis. It's a fascinating topic, so let's just dive right in.
Here is our roadmap for the breakdown. We're going to start with the problem and the regulatory change, move into the article fact sheet, hitting all those key metadata points you need for a lit review, walk through the methodology and the sample, reveal the main findings and contributions, look at a really interesting detail involving the pandemic, and then finish up by outlining the gaps for future research.
All right, kicking things off with Section 1, the problem and the change. To really understand the context of this paper, we have to travel back to the fallout of the 2008 global financial crisis. So, during the 2008 crisis, regulators realized the old accounting model, the Incurred Credit Loss or ICL model, was fundamentally flawed. It was totally backward-looking. Banks were only setting aside money for bad loans when there was already objective evidence the loan was failing. Regulators literally called this too little, too late, because it actually exacerbated the financial crash. So, in response, global standard setters mandated a massive shift to the expected credit loss, or ECL model. You might know this as IFRS 9 internationally or CECL in the US. This new model is forward-looking. It forces banks to anticipate future losses and actually provision for them before loan defaults. It's a massive shift from simple reaction to proactive risk management.
Okay, moving right along to Section 2, let's get into the article fact sheet and map out exactly what paper we are dissecting today.
For those of you building out your literature reviews or writing a thesis, here is your essential rubric checklist. We are looking at a paper published in 2021 by authors Lopez Espinosa, Ormazabal, and Sakasai. The origin of the research spans institutions across Spain and the USA. The title is Switching from Incurred to Expected Loan Loss Provisioning, Early Evidence, and it was published in the highly respected Journal of Accounting Research. The type of paper is empirical research, and your crucial search keywords here are ECL, IFRS 9, loan loss provisioning, and bank accounting.
And just to anchor why this specific paper matters so much, this shift wasn't just some minor tweak to an Excel spreadsheet. The Global Public Policy Committee explicitly stated that, for many banks, adopting this expected credit loss accounting would be the most momentous accounting change they have experienced. The authors of this paper are essentially examining a regulatory earthquake in real time.
Which brings us to Section 3. How exactly do you go about measuring an earthquake like that? Let's look at the methodology and the global sample. The authors used a really elegant three-step empirical method here. Step 1. They identified banks globally that were adopting IFRS 9 back in 2018. Step 2. They looked at the mandatory Day 1 impact disclosures. See, because banks had a transition, they effectively published their loan loss provisions under the old IFLC rules, and then for the exact same portfolio under the new ECL rules on the exact same day. This beautifully isolated the effect of the rule change. Then, Step 3. They analyzed how the market reacted to that newly revealed information by tracking stock returns and credit default swap, or CDS spreads.
Now, for their sample, they didn't just look at small regional banks. They specifically targeted 293 systemically important banks. We are talking about the absolute titans of the global financial system, the ones that are considered too big to fail.
And to make sure their findings weren't just some localized anomaly, they sourced these 293 banks from across 74 different countries. It's a truly international dataset.
When you add all that up over their testing period, it resulted in a massive dataset of 1,233 firm-year observations. That sheer scale is what gives their empirical findings such robust, undeniable academic weight.
So, the million-dollar question is, what did all this data actually prove? Let's unpack Section 4, Main Findings and Contributions. The verdict of the investigation is pretty definitive. First, the new ECL provisions predict future bank risk far better than the old ICL model ever did. When banks revealed a large increase in their provisions on day 1 of the new rules, the market reacted instantly. Stock returns dropped, and CDS spreads, which are basically insurance premiums against default, shot up. The market clearly recognized that this new accounting method was revealing true, previously hidden risk. But honestly, the most important finding is this. These effects were overwhelmingly strongest in countries where credit conditions were already deteriorating. The ECL model essentially acts like a highly sensitive alarm system that blares the loudest right when the economy starts to crack. From an academic standpoint, the main contributions of this study are huge. Before this paper, most of the literature on IFRS 9 had to rely on theoretical computer simulations. This paper provides the very first early empirical evidence using hard, real-world data. Furthermore, it explicitly proves the value of provisioning for non-defaulted loans, which was exactly the primary goal regulators had when they scrapped the old system.
Now let's look at a really interesting detail from this study. Section 5, the pandemic.
Talk about a crazy plot twist. The authors finished gathering their 2018 data right before the world completely changed. As COVID-19 cases surged in early 2020, sovereign CDS spreads skyrocketed in perfect tandem. Because the new ECL model is so hypersensitive to forward-looking economic deterioration, the pandemic acted as this intense, real-time stress test. It forced banks to instantly anticipate massive future losses. Which brings us to a highly controversial concept.
That concept is procyclicality. The great fear surrounding the expected credit loss model is that it might actually make a sudden crisis much worse. Think about it. If a shock like COVID-19 hits, the model forces banks to immediately book massive provisions for future losses. This eats up their capital, which then forces them to restrict lending to the public exactly when the public desperately needs cash, thereby deepening the economic recession. The authors actually note that standard setters had to urgently intervene during COVID to soften the rules, just to stop this vicious cycle from spiraling out of control.
This brings us to our final section, Section 6, Gaps and Future Research. If you're looking to carve out your own thesis topic, pay close attention here.
So the main gap this paper addressed was the total lack of post-implementation data in the existing literature. But they also highlight some massive gaps that are still wide open. Future research is desperately needed in three main areas. First, time variations. How do banks learn and adapt their accounting behaviors to these rules over time? Second, we need a direct comparison between the international IFRS 9 rules and the US CECL rules, because they have subtle but really vital differences in how they calculate the lifetime of a loan. And third, analyzing the real economic effects. Did banks actually lend less overall? And what were the massive operational compliance costs of building these complex new risk models in the first place?
We'll leave you with this provocative thought that really summarizes the ultimate dilemma of this whole topic. The expected credit loss model clearly works. It successfully warns us of danger. But if it forces banks to choke off lending during sudden, unexpected crises like a pandemic, is the cure actually worse than the disease? It's a fascinating question, and it's one the academic community is going to be wrestling with for years to come. Thank you so much for joining us for this explainer, and best of luck with your research.